Welcome back to the channel. I'm going to walk you through one of the most mathematically damaging investment mistakes I see retirement investors making today, and it centers on JEPI, the JP Morgan Equity Premium Income ETF. Let me start with the headline number that hooks most people: JEPI 9% yield. On a $200,000 investment, that sounds like $18,000 per year in passive income. Sounds fantastic, right? Most investors see that 9% yield in their brokerage account and think they've found the holy grail of retirement income. But here's what the brokerage statement doesn't show you. When tax season arrives, that $18,000 gets demolished. Let's walk through the actual math. JEPI distributes approximately 9% annually to shareholders, but here's the critical detail that most financial advisors gloss over. About 80% of those distributions come in the form of short-term capital gains. This is the key to understanding why JEPI is so deceptive. In 2024, short-term capital gains are taxed at your ordinary income tax rate. For someone in the 32% federal tax bracket, which includes married couples earning $191,950 to $243,725, plus a 3.8% net investment income tax that applies to high earners, plus state income tax, let's say 5% in a moderate state like Colorado or Virginia, your combined marginal tax rate sits around 41%. So that $18,000 in JEPI distributions, you're actually paying approximately $7,380 in federal taxes alone. Add state taxes of $900, and you're down to $9,720 in net income. Some retirees in California or New York with state income taxes over 10% will see their net yields drop to just $10,000 or lower. Let's compare this to the alternative that most retirement advisors should be recommending: the Schwab U.S. Dividend Equity ETF. Currently yields approximately 3.6% annually. On that same $200,000 investment, that's $7,200 per year. But here's where the magic happens. About 95% of distributions qualify as qualified dividends. Qualified dividends receive preferential tax treatment under IRC Section 1H11. If you're in that 32% federal tax bracket, qualified dividends are taxed at just 15%. Add in the 3.8% net investment income tax for high earners, and you're looking at roughly 19% total federal tax plus 5% state tax, bringing your effective tax rate to about 24%. That means on $7,200 distributions, you pay roughly $1,728 in taxes, leaving you with $5,472 in net income. Wait, that sounds worse than JEPI $9,720. But this is where most investors stop analyzing, and this is exactly where they make the mistake. You can't just look at current yield. You have to look at total return, which includes price appreciation. Here's the mathematical truth that changes everything. It has historically delivered annual total returns, dividends plus capital appreciation, of approximately 10–12% per year. Why? Because when a fund isn't distributing all of its earnings as current yield, those earnings stay inside the fund and compound. When management retains earnings, reinvested gains compound tax efficiently. JEPI, conversely, has delivered total returns closer to 9% annually because it's already distributing nearly all of its earnings as current yield. The fund is engineered specifically for current income, not wealth accumulation. Let me show you what this means over 30 years with actual numbers. Starting investment, $200,000 in either JEPI or SCHD. Assumption: JEPI delivers 9% total return annually after fees. SCHD delivers 11% total return annually after fees. These are conservative, historically backed estimates. After 30 years with annual rebalancing and reinvested dividends, JEPI at 9% total return equals approximately $2,090,000 in pre-tax value. SCHD at 11% total return equals approximately $3,450,000 in pre-tax value. Now let's calculate after-tax value. Assuming you sell the entire position and pay capital gains taxes. For JEPI, you've paid taxes annually on distributions. Let's estimate total tax drag of roughly $8,500 per year compounded over 30 years, which totals approximately $487,000 in cumulative taxes paid. Additionally, when you sell after 30 years, the remaining $2,090,000 position has a tax basis of only roughly $200,000 because distributions reduce basis in some scenarios, though wash sales apply. You'd owe long-term capital gains tax on approximately $1,890,000 of gain at 20% plus 3.8%, equaling roughly $428,000. Total tax bill, approximately $915,000. After-tax wealth, $175,000. First, your annual tax drag is minimal because most distributions are qualified dividends at 24% tax rate, equaling roughly $1,728 per year. Over 30 years compounded, this is approximately $78,000 in cumulative distributions taxes. When you sell the $450,000 position with a basis of roughly $200,000, you owe long-term capital gains on $250,000 at 23.8% total, equaling approximately $775,000. Total tax bill, approximately $853,000. After-tax wealth, $2,597,000. The difference, asterisk asterisk $1, $422,000 in additional after-tax wealth with asterisk asterisk. This isn't theoretical. This is the compounding mathematics of tax efficiency over 3 decades. Now, let's dig into the SEC filings to understand why JEPI is structured this way. JEPI prospectus and fact sheets reveal that the fund uses a covered call strategy on approximately 50-70% of its holdings. Here's what that means. The fund sells call options against its stock positions. When those calls expire out of the money, the premium collected is profit. When they expire in the money, the fund's shares are called away and repurchased at higher levels. Either way, this generates option profits that are classified as short-term capital gains under IRC Section 1222A. This is deliberate strategy. J.P. Morgan's fund managers know that option writing generates short-term gains. They chose this structure specifically to create a 9% yield number that would appeal to income-focused investors. From a pure marketing perspective, it's brilliant. A 9% yield on your brokerage statement is compelling. A 3-6% yield is boring, even if the 3-6% fund ultimately delivers superior wealth. But from a fiduciary perspective, that is, from the perspective of acting in the investor's best interest, it's problematic. The fund structure optimizes for current yield at the expense of after-tax wealth accumulation. Let me address the counter-argument I know some of you are thinking. But what if I need the income right now? What if I'm retired and need to live off this money? Fair point. If you genuinely need $18,000 per year in income from a $200,000 portfolio, then JEPI might seem necessary. You can't eat tax-deferred gains. But even in that scenario, there are better alternatives. A portfolio of 40% JEPI and 60% SCHD would give you roughly 5% yield, about $11,000 annually, but with significantly better tax efficiency and higher total return. Over 30 years, you'd be in a similar current income position, but with substantially more wealth remaining. Alternatively, you could hold SCHD and simply take 3-6% as distributions while letting the additional capital appreciation remain invested and unstimulated. You'd have control over your tax timing. Or, and this is the most elegant solution, you could use a systematic withdrawal strategy where you take 4% from your SCHD position annually, capital appreciation plus distributions, generating more current income than JEPI 3-6% yield while maintaining better tax efficiency. Here's the final calculation that should resonate. If you're 55 years old today and you invest $200,000 in JEPI versus SCHD with the goal of having maximum wealth at age 85, the JEPI decision costs you roughly $4 million in real dollars. That's not a minor difference. That's the difference between a comfortable retirement and a strained one. That's potentially the difference between leaving an inheritance and running out of money. The takeaway, don't chase yield without understanding the tax consequences.